Hey, welcome to the Airme Roundtable. Today's the 8th of February, 2023. Have a special guest, Kerry Given. Kerry and I think, met in the Sheridan community years and years ago. So we've known each other for a long, long time. It's been a while since we've actually talked. So this is nice to reconnect. And I just found out Kerry's in Illinois, and I grew up in Illinois. So kind of a fun connection there too. So Kerry's been working on Iron Condors for many years, and I'm sure your talk, Kerry, will be very interesting to the Aramir community because we also do a lot of Condors, especially lately on zero DTE. But that's another topic, I guess. But welcome, and it's nice to have you here.
Thank you. It's my pleasure to join you. And it has been a long time. We do go way back. My journey with the Condors lengthy. In fact, as I was going through these slides today and decided on an appropriate title, I thought, man, I'm an old man. And I am, but still, I've been doing this a long time. We started at what we call the Flying with the Condor trading service in Parkwood Capital in 2007. And I've looked back through what I've been doing, and I'm terming the first 7 years as kind of the years of innocence. And then the next period is where I'm kind of changing and trying different types of strategies. And then probably since 19 or 20, I've had a pretty consistent strategy for opening, closing, adjusting, and so forth. And so there's a lot of different aspects to the Iron Condor, of course. Which index are you going to use, time to expiration, etc. But I just want to take you through my experience and what I've found. I'm not going to suggest that what I'm doing now is the best way to trade the Iron Condor, because I think that's foolish, but because there's different aspects to it in terms of how you configure it that may suit you more than someone else, and may be more appropriate for you depending on how much time you have to watch it and so forth. So the basic structure that we've set up for this service is I recommend that the client set aside either a portion of an account or an account that he's going to trade with this, and just take 40% of the capital in each position that we put on, because at any point in time through the month or through any period of the year, we'll have two positions on, one in the current month and one in the next month out. Like right now, for example, we have March and April open. We've already closed January and February. So when I closed February, I went out and opened April, and that's the way we go through the year. And then we keep 20% of the capital in reserve for adjustments. And so that's how we structure this trading service. Now, when I first started in 2007, I was primarily selling the Iron Condors on the Russell Index, the Russell 2000. And as you'll see in the next series, I forget when this started, I think roughly 17 or 18 is when Russell decided, or actually the SIBO decided, they were going to charge much higher fees for the Russell data, option data. And so suddenly I lost that opportunity, basically, because I couldn't get it in my charting software or my options analysis software. But in those days, early days, I was trading mostly Russell, occasionally SPX, but we started with about 50 to 60 days to expiration. I would position myself about 1.25 standard deviations out of the money. And so what that meant is when we first started the trade, probably our maximum gain might be as low as 10% and probably rarely got as high as 12%, but somewhere in that range. The adjustments that I used early on consisted of two possibilities. One was what I called the 200% rule. And basically how that works is you look at each spread, puts or the calls, and you say, okay, if I put this spread on for $1 credit, you track that over time. Each day as you look at it, you just ask yourself, okay, what would it cost to close the spread? And when the debit is twice the original credit, you close it. That's basically the 200% rule. Now, the beauty of the 200% rule is that it's pretty unusual for you to close without being pretty close to break even. You might have a small gain, but it's going to be a small loss if it's not a gain. And in fact, the 200% rule is what I've always recommended to my coaching students as where they should start with the Iron Condor. If they're going to trade the Iron Condor, I've always told them, start with just 1 or 2 contracts and do this for at least 6 or 8 months, maybe even a year before you start scaling up. And the best, easiest, simplest way to adjust it is just follow the 200% rule. The disadvantage of the 200% rule is this: you close a lot. So you might end a year having closed 9 of your positions or something like that. But the beauty of it is I would have coaching students that would go out and in their first year would have a positive gain. And frankly, with Iron Condor just starting, that's unusual. But what I primarily used in the Flying with the Condor service with my clients was the long hedge. In other words, if the index started moving down toward my put spread, for example, I would, at some point, usually a delta value, I would trigger my long hedge, which meant simply that if I was short, let's say the 1200 put in those days, in the Condor put spread, if I was short 1200, I'd simply go out to the next month and buy a $1,200 put. And usually I was doing like 1 to 10 contracts to start with. So I have 10 Condors, I'd buy 1 put hedge. And if it continued to go lower, I'd buy a second one and so forth. And then as it bounced, if it did bounce, then I would start peeling those off. And that works very, very well on the downside. In those years, I was actually using that on the call side as well. And that didn't work as well. So on the next slide, where I talk about how things changed, that was one of the things that changed. The 2 sigma rule is something that I developed early on. I think, a lot of things in this business, you generally pick up from someone else. The 200% rule is one of those. I picked that up from a book that I read, and the guys that wrote the book were trading commodity options, but this was their rule for how they would get out, how they would close. Now, the 2 sigma rule, I think, is my rule, but sometimes you forget about where you found it, but I think I developed this. But in any case, I've always called it the 2 sigma rule. And essentially what I do is on a Friday prior to expiration week, a week from expiration, in other words, I calculate 1 standard deviation for that period of time, remaining 7 days, and whatever the VIX is on the SPX. And then I look at both the spreads and calculate how many standard deviations out of the money is each spread. And if it's 2 sigma or less, then I leave it alone. If it's, I close it. And if it's more than 2 sigma, then I leave it alone. And if I decide to leave it alone, leave it open, I will track that through the next few days and may close it if it deviates from that. But typically, if you're 2 sigma out of the money, usually unless you have some dramatic moves, you're pretty safe. And so I choose to do that to save the commissions closing on the other side. Now, roughly from 2015 to 19, and this is all kind of rough because obviously you don't wake up one morning and say, I'm going to do this. It's a gradual process. But during that period, I think it was 17 or 18, is when the Russell option data just simply priced itself out of reasonable play. And for example, I do my price charts with stockcharts.com, and StockCharts quit listing the Russell index. You couldn't draw the chart anymore. And then my options analysis software is the Platinum software from Optionetics, and they dropped Russell as well. And so I dropped Russell. And so since then, since roughly 18 or so, I've been trading just SPX. I still was starting roughly at 50, 60 days out and was still calculating roughly a 1 1/4 standard deviation thereabouts. And so my opening gains were something in the order of 15, 17%. Typically, you'd be closing a little less than that. I still list the 200% rule because that was still what I was teaching my clients. Although if you were in my service and following my alerts, we were using a long hedge for the put spreads, but we were closing and rolling higher on the call spread side. So that was one of my earliest shifts that I just decided that when I would buy a call farther out in time, a month out, that because volatility is dropping as the index went higher, that those calls just didn't gain much value. and consequently weren't very good hedges. Just the opposite is true on the put side. I think it was 2015 or 16 when we had a pretty significant correction in the fall. And I remember it well because I don't remember exactly what the strike was that my put was short, but on the day that the index actually hit my short put, I was at break even with that put spread and with the entire Condor actually. And that was the power of those puts that I had bought. I think I was up to 3 puts for my for each 10 contracts. So I had a fair number. I just bought them as it dropped. And then that day, as it touched my short put, that happened to be the low for the day. And sure enough, it bounced from there. And so I started peeling my puts off. So that long hedge on your put side works extremely well. And I still do that today. But on the call side, you really need to just close the spread and roll it up or close it all together. I still use the 2 sigma rule. In this period of time, I was still taking those spreads down to that Friday before expiration week and then applying the 2 sigma rule to decide which ones I leave on. Now, from roughly 2019 to the present time, I've been trading only SPX, so there's no change there. The 60 to 90 days. Now, I've listed that as 60 to 90 days because what happens now under the rules that I'm using is I end up often closing a spread pretty early. I can get a good return, and so I just close it and then roll out, or not roll out, but go out to the following month, the month after this next one, and open the next Condor. Well, just like, for example, here in February, we closed early. And so that meant that I needed to roll out and open the April. Well, April, I opened up at 97 days to expiration. And it wasn't because I want to do it at 90 days. It's a matter of when the capital was available and I needed to open the second position. So what I found with the current way I'm doing it based on these rules, I often will close a spread early, getting a nice return. And I may still have quite a while to go in that expiration, and yet then I'm going out to the next month. Actually, in October of last year, I had 2 October Condors. I closed one early, and then I had plenty of time, and so I went ahead and opened the second one. And actually was only in the second one for a week or 10 days or something like that. But that's one of the things that happens with this particular set of rules, is that you may hit a reasonable profit, in fact, have like a profit stop, if you will, early. And therefore you may be rolling, or not rolling, but going out to the next month, and you may have quite a few days to go to expiration. In any case, I set up my spreads here now, based primarily on a delta as kind of my approximation of the standard deviation calculation. And I usually am selling the short option at about 15, maybe even up to delta of 20. And what that means is that when you open these condors, you're looking at a pretty high potential gain, 30, 35%. Now, in terms of adjustment, I still teach the 200% rule, but for people that are getting into this, because I think that really is the best place to start. And I also talk about the long hedge for the put spreads, and I use that myself, but I don't use the long hedge for the call side. There, I just close and roll higher. And I do close and roll the puts higher after I rolled the call spreads higher. So this particular group of rules involves a fair amount of activity. And in fact, one of the things I'll talk about in a couple of minutes is how different Condor strategies and rules are also affected by what kind of time you have to deal with this. And what I'm doing now presumes that you're in the market every day and watching it pretty closely. Now, the other difference here that I do now is when I get a position that gets up to 15, 17, 20% gain, it really doesn't matter to me if I have 3 weeks left or a week left or whatever. I close it, I take the profits. And if I get to that Friday before expiration week, then I'll apply the 2 sigma rule, because if you get down that far and you have spreads that are left way out in the boonies someplace, if they're more than 2 standard deviations out of the money, it doesn't make any sense spending money closing. Now, you might wonder how this has worked. I've got my most recent results here. Right now, we're up 11% because we've closed both January and February. March and April are open right now. So we're up 11% after just a couple months. So we're doing quite well this year. That's kind of a strong start. Last year, we finished the year at 38%. And I noted here it included two losses that were about 20% each. I think one was like 19 and the other was 22 or something like that. So what I'm trying to emphasize here is that I'm not trying to pretend that you won't have any losses. You have to, this is at least the way I trade it, it's a reasonably aggressive strategy. And I think there are advantages to that, which I'll talk about in a moment, but it doesn't, if you're looking for something where you rarely, if ever, take a loss, this may not be the way to do it. And then in 21, we were up 35%, only had one loss. In fact, that year, I think December was our only loss, and it was like a 7% loss. So it was a magical year. 20 was a pretty good loss because we never got over. I took losses in the first quarter, biggest one being in March, and we never recovered from that. We had gains the rest of the year, but we just never could crawl out of that hole. And then in 19, we were up 11%. But that included 4 losses. So my point once again is that you will have losses. The bottom line, which is true of all trading, is do your gains outweigh your losses? And what that talks about is risk management or trade management. Now let me talk about just the next couple slides, and then we can have broad discussion. Some of the things that I think are critical to Iron Condor trading and really trading options in general. Number one is probabilities. Let me tell you a brief story. I wrote my first book in 2011, and it was later that year, I think it was in the fall, and I was at one of the either Traders Expo or Money Show conferences. I'd been invited to speak, and a guy came up after my talk, and he had my book in his hand, and my immediate thought was, oh no, he's found a typo or something. And he turns to chapter 2, which is where I discuss probabilities, and he points to the line I had, and I think we actually printed it in red. But the bottom line that I built through that chapter was the risk-rewarded or the risk-adjusted returns for any options strategy will trend to 0 or probably negative after all the costs are included. And of course, he found that he turned out to be a pension fund manager in California. And he had decided that he was going to add options to his pension fund trading. And he bought my book, and he found that chapter and he was shocked. He read that and thought, well, heavens, why would I ever do this? And he told me that he brought that up and told me, he said, I came here to meet you. And he said, I also, yesterday when I got here, I took the book and I went down through the exhibit hall, and at every booth, I pointed out this statement and wanted to know if they agreed with it or not. And he said, it was really interesting. He said, I found several people that just immediately said, yeah, that's absolutely right. That's what the probabilities calculate. And then he said he found other people that was almost like I had said something that made them kind of uncomfortable, and they would say, well, yeah, but we have a better system or whatever. And of course, my point wasn't and isn't now that by saying that that's the way the probabilities work out, I'm not saying it's not possible to make money trading options. What I am saying is if you just put on a trade, let's say, for example, you decide you're going to put on a straddle, an at-the-money straddle on the S&P 500 on the first trading day of every month, and just let it run until it expires or it goes into money or whatever. Well, if you go down to the floor and talk to any money manager, any market maker, I should say, and suggest that strategy to them and say, well, how's that going to turn out after a year or so? They're going to tell you almost immediately. It'll be just a knee-jerk reaction. You're going to break even at best because they understand the probabilities. You know, the bottom line is that there's no free lunch here. So when you look at the probabilities, now the other error that people make is they calculate an options trade and say, oh, I've got a 90% probability of success. Okay, that's wonderful. And that sounds like it's free lunch. Well, you have a high probability of those options expiring worthless, but of course you sold them for a fairly small credit. And what you may not realize or may not be as apparent to you is that you have a rather large potential loss, but you've neglected to think about that much because you say, well, it has a very low probability of happening. It's maybe 10%, something like that. The problem is if you go through the math, that one loss will probably wipe out most of your year's gains. And that's how this balances out over time. So that basically you end up at zero after a year or 2 years or whatever. So the problem here is that when you sell a credit spread for a small credit, that high probability is what gets us into that. But what we don't realize until we get a little more sophisticated, start talking about adjustments, how do I hedge this when it moves against me, et cetera, you start to figure out that every time I make an adjustment here, it's cost me money. Well, if I only sold this spread for a dime or something, it's most likely I'm going to be way in the hole just closing it, even though I didn't take a huge loss. I took a loss because my adjustment wiped all of that credit out very quickly. And that's why the 200% rule actually is a good place for beginners, because there you're closing early enough with a debit that wipes out that one credit plus an equal amount. And typically, whatever credits you received on the other side is going to be similar, so it gets you pretty close to break even. And so that's why that works. But generally speaking, if you're hedging, trying to close these things or trying to buy some kind of a hedge or whatever, it's a lot easier if you've started out with a larger credit, because then you don't go into the hole so quickly with your first adjustment. And of course, what that means is if I'm starting with larger credits, I'm starting with lower probabilities of success. And when you think about it, that makes perfect sense, because one of the most fundamental laws of finance, and it doesn't matter if you're trading options, currencies, whatever, is the larger the gain that you think is available, the more risk you're taking. There's no question about that. So if I'm collecting this nice big credit, there's a lot of risk out there. There's a potential large gain, but there's a lot of risk. And just like when I talked about the guy with the pension fund in my book, he was shocked to read that statement about the probabilities in this options market. Now, why was he shocked by that? Well, he was shocked by that because nobody talks about it. You know, that's the main reason that I named that first book, No Hype Options Trading, because I was annoyed. In fact, that isn't a strong enough statement. I was annoyed by all of the blind alleys that I had coaches take me down. Because I learned this on my own after I had retired. And I have a pretty strong math background. And so I felt like, well, as Yogi Berra used to say, I'm smarter than the average bear, and I can do this. And I was just amazed at the different things I found that nobody had talked about. And so anyway, that's my point about probabilities and option trading. Another area that people get confused about is with implied volatility. Condors are negative vega positions. So therefore, as IV goes up, it hurts your trade. As it goes down, it helps you. Now, the only time you really benefit from that is if you decide to sell a condor right before an earnings announcement on the stock, because then you can position your spreads way out of the money. And just as the implied volatility drops as soon as the announcement is done, that position will gain in value, assuming, big assumption, assuming that the underlying stock price doesn't hit one of your spreads. But otherwise, I've seen people make statements like, when implied volatility is high, that's when you want to sell your Iron Condor on SPX. Well, if they're doing that on the basis that I always sell the spread 100 points out of the money, or always sell the spread at whatever place, well, then that's foolish, because what you're doing when implied volatility is higher is you're taking more risk. If you position that still at 100 points out of the money, that's a much riskier position than it was before when IV was low. So that's why it's so important to use a standard deviation calculation, or even look at delta as your approximation of that, to figure out where to put your spreads, because then you're adjusting your risk to be more consistent from month to month, because you're adjusting it with implied volatility. So the idea that condors are negative vega, that's almost, you can keep that in mind, but it's not something you should be thinking about when you're trading iron condors as a time decay strategy, an income strategy over time. Because you want to shift with the market so that you're always collecting the same, roughly the same credit each month, because that means you're taking the same risk each month. Now, the other thing to keep in mind that, again, I didn't learn until late in my education is the realization that when IV changes, it doesn't change the profitability of your spread. A vertical spread, when you sell that initially, that credit is your maximum gain, and it doesn't change. IV can go up and down, whatever, it's not going to change. It just makes a difference in terms of where this thing closes. But it does make a difference if you're trying to get out of the trade. Because if you have some modeling software, put on a trade, a credit spread, and play with your software, and adjust the volatility while you're in it. What you're going to see is the risk reward curves, not the one at expiration, but the ones in between at different times. Like the software I have, it gives you a line, excuse me, it gives you a line for today, and then it also divides the time to expiration in thirds, so it has two more curves to show you how the decay is occurring, will occur, predicting how it'll occur over time. Well, what you'll see if you increase the IV in your software, the next plot you bring up, all those curves will have kind of straightened out. They moved away from expiration curve. Almost like if it was a string, it pulled a taut. And so now it's more of a linear line, rather than being curved in toward the expiration curve. And so that's why you often find yourself in a credit spread and you're thinking, wow, the price of the stock is up above the spread, it's doing well, but what's the problem here? Well, if IV is increased for that stock for whatever reason, you're going to find that even though you should be able to get out with your maximum profit, you're not going to be able to. You may have to wait until you get very close to expiration. So that's the effect of IV in this game. So now let me address the trade-offs. Each style of Iron Condor has a different pattern of gains and losses. I've shown you some of that in my own history of what I've done and what I've changed. As we increase time to expiration, one advantage of that is you get a wider break-even range, or you might think of that as your profitability window. But there's a trade-off there, and that's event risk. We often don't think about event risk. I think about it a lot because there have been entirely too many times where I had a trade that was doing just wonderful. And then one day, something happened. I mean, it could be what some politicians said, it could be what the Fed did, it could be war, it could be who knows what. And suddenly my trade's in trouble. So the longer you're in your condor, the more possibilities you have for some kind of event causing you a problem. Now, what about when we move our strike prices less out of the money, closer to the index price? Well, immediately we see that our credit or our maximum profit's going up. That's wonderful. We're all happy about that. The risk-reward ratio is actually going down, so that's good. But the other thing you get is you have a position now that the P&L, the profit and loss, each day can change a fair amount. Now, does that suit you? If you're, like when I had my corporate job, I was traveling a lot, I was on the road, I may not see the market for a couple of days. At best, I might see it each evening after it's already done. So that type of condor might not suit your position in life, so to speak. But the other problem here is as you move those strikes in closer, your probability of success is going down. So that's another reason you need to keep track of this closely. But what about the other? Sometimes we look at that and say, well, the other end of the spectrum must be the good one. Let's move our short strikes way out there. You know, I've known people that set up condors and they're collecting 25, 30 cents in their spreads. Well, as you move out there, you've got a great probability of success. It gets up 90, 95%. But you're not collecting much credit. It means even if everything expires worthless, you didn't make much. But remember, this is a fixed spread value. If my credit is a small number, let's say it's 50 cents on a $1,000 or $10 spread, then that's $950 maximum loss. Oops, that doesn't sound so good, does it? Now, the other thing that comes with these spreads, though, they're a lot farther out of the money. You could say they're safer, but they move a lot slower. Now, I've had clients that actually get bored with that. They think, oh, this is terrible. I just don't want to do this. So again, part of this depends on your own style. So the bottom line here is that I've talked about a lot of different rules, different ways to set up condors, different ways to manage them. But my condor might not be your condor. And that's not that mine's good and yours is bad. It's just that we have different risk profiles. We have different positions in life in terms of whether we have time to watch this trade. And we probably have different values. You know, I have some clients that actually subscribe to the Condor service and other trading services that I have, especially because they don't like it. You know, they've taken my coaching classes and gotten to the end of it and said, you know, this is fine. And I'm glad that I understand it better so I can talk to my advisor and so forth. But I don't want to do this. It just does. I'm not interested in this. I want to go play golf or I want to play with this business that I'm starting or whatever it might be. They're just not interested. Well, that gets to our style, right? I mean, I find this very fascinating and interesting, but not everybody does. We're not all the same. So that may be shorter presentation than we expected, but I didn't want to bore you with wandering around the barn too much. I certainly am free to answer questions if there are any.
I know you mentioned, you said you're using Optionetics Platinum. I used that a long time ago. I mean, we're talking probably 20 years ago. Are you still using it today, or?
I am. I usually, whenever I'm talking to my students, and I'll do it here, I emphasize that I use Platinum, but I warn them to be very careful about anything else from that organization because it's I mean, whatever the latest thing is, they're on top of it. I mean, they're very big in crypto now, naturally. And so it's, you know, it's almost a day trader organization, really. It's I think, entirely too much marketing hype and so forth. But anyway, I love that software. I use it every day to model trades and backtest trades. And the best thing about it, in my opinion, it's not the only place you have it, but I like it, is that it plots these risk reward curves so that I can figure out how much time decay I might get in the next week as opposed to waiting till expiration and so forth. And there are other stuff. I think there's is Option View still alive? I'm not sure.
Yeah, they are. Len sold it a few years ago to Brian Vogelman, and they're recoding it right now, but it'll probably be at least 6 to 12 months before they're ready to release a new version. Yeah, and then go ahead.
Back when I made the decision to use Platinum, I looked at Option Views, tried it out. They, you know, were able to give you the software for free, just try it. But the problem was what they wanted for the real-time option data. I mean, at that time, I think you were having to spend like $5,000 a year just for the data. And
yeah, I think it's more like 100 or 200 a month, but it gets data from Thinkorswim and Interactive Brokers, which most people have one or the other. So usually data is not a big problem.
Oh, so that's a little different than when I looked at it, but that was a long time ago that I looked at it.
Well, and then there's Optionnet Explorer, which Andy was a mentoring student at Sheridan Mentoring and liked OptionView but didn't want to pay for it. So he was a developer and wrote his own version, and that turned into a whole business, Option and Explorer. But it's an OptionView knockoff essentially, but about half the price.
Okay.
And then there's a few new ones. There's a options trading assistant, I think it is. I know Steve Gantz, I saw him on this call earlier. Steve's been using that. It's a web-based one. It's fairly new, but it looks pretty interesting.
What's the name of that one?
Options trader assistant, I think. And if Steve's here, he might want to chime in, Steve.
Yeah, it is. It's Options Traders Assistant. The developer of that he's been extremely responsive at adding all sorts of cool new stuff. The thing I like about it is web-based, so it connects directly to TDA and some other brokers. So I actually fire my orders in through there. When the orders get filled, it updates my P&L diagrams. So it's pretty slick from that standpoint. The one thing it is missing, though, where the others have back testing, where I can go back and play a trade that I put on in March of 2000 and try to figure out a better way to do it. It does not have that historical data like OptionNet Explorer and OptionView have. So it is missing that one component.
Well, that's primarily, I kind of latched on to Platinum way back when, and I just I liked the fact that it was web-based, and because I use a Macintosh, and so I was always being caught by this having to have Windows modeling software in order to run some of these things, and so that was part of my prejudice. But anyway, it's done well for me, even though it's got a checkered history. The Options Express bought OptionX first, and then they never really did much with it because I think they were kind of freaked out by it. And then after Schwab absorbed everything, Tom Gentile, one of the founders of OptionX, came back to them and offered to buy it. And he probably made out like a bandit in terms of what they sold it for. But if any of you that have watched any of Gentile's webinars and so forth, if you have much of a hyping meter, it's probably hitting its top peg. But anyway,
I had a seminar with Tom and George in Vegas one time, and he's a really interesting guy. Both of them were.
Yeah, I like George a lot better. I felt like George had more meat, but anyway, it's a shame to see him gone, actually.
So the Platinum software is, I think I saw it was on Tom Gentile's website. So he's the one that owns it now.
Yeah, that's right. It's about
Okay.
$80 a month, something like that.
Okay. Does it have back testing? I can't remember. It's been so long since
It does.
Okay.
The only disadvantage of its back testing, as opposed to what we had in OptionView way back when, is it does only end of day pricing. So you're
Okay.
that is a limitation, no question. But
Yeah, OptionView is still 15 minute, and Option Explorer is 1 minute. And I don't know what Option Traders Assistant's plans are, but I assume that they're going to try and build back testing at some point. But Steve, you might know that if they're planning that or not.
I don't for certain. I don't want to speak for them on that. I mean, I do think, yes, they recognize that that is available in some of the other products. So, but I think they're focusing a little more toward the educational content or the educational kind of student mentor side. What I mean by that is he's built in some pretty cool stuff so that you can plan an entire trade in advance and then get alerts when certain conditions are met or hit. And a student can copy all of that by clicking a single link. So I think they're focusing a little more that direction, but I do think back testing will be on the radar. I think he's collecting data, but I think there's other priorities first, I guess is maybe the best way of saying it.
well, you described a very, very nice feature, actually. That's interesting.
Yeah, and I do think that's going to be kind of the differentiator for them is, again, for example, or you as an instructor or a coach, you can build out this Iron Condor, and as part of your Iron Condor build out, you can go ahead and put in very specific adjustment points. And then if your student copies that trade, everybody's going to get notified. You don't have to send out an alert. All of us that have the platform will get notified. Hey, your adjustment of whatever it is, a delta criteria, a days to expiration, whatever, we'll all get notified of that from our own respective platforms.
That's cool. That's
Yeah, I put the
impressive.
link in the chat for you, Kerry, but guess there's lots of choices. I'm curious to see what Option B is going to come out with because they've been working on this for quite a while. But they're still expensive. And I think Option Traders Assistance about what, $100 a month. Steve, is that about right?
They've got 3 different levels of it. Depends kind of on what you need. That will be a conversation I'll be having with him, is that I feel he might need to get a little more competitive there. But right now we're still working at getting everything dialed in. I say we, I mean, he's doing all the work. I'm just a person that uses it daily. I manage probably 30 open trades with it. And I'm just providing him feedback at this point. So as a user, but
Sure.
so yeah.
So you're the beta tester.
I am one of the many beta testers, but I get the impression that I probably am hammering it harder than many of the other beta testers are, because I'm hammering it across multiple accounts, multiple types of positions, you know, taking assignment of stock, a whole bunch of different things that I don't think your average user has probably poked at it with before.
Well, that's valuable input. He ought to give you a lifetime subscription or something.
He's been, what he's done, I mean, yes, I think that is in the wings as well, but regardless of that, I think probably the more important thing is that he, to me, is that when I give him many of these suggestions, or I say, listen, this doesn't feel like it's working quite right, usually within 3 to 5 days, he's got it resolved. So he's been extremely responsive at,
that's good.
you know, at updating it for what I and other traders have indicated to him are important features. I mean, I've suggested things to OptionNet Explorer for 3 years, and I haven't seen a single movement on any of it. So this is a new experience for me to get that level of response on a request.
Well, that's good. That's good. I've been hanging on to my platinum, and well, I guess I'm used to it now. If I'm so used to it that it'd be one of those things, if it suddenly disappeared tomorrow, I'd be kind of semi-panic. I guess that's, maybe I shouldn't admit that, but I use it every day.
Oh, and I just noticed that the webinars now at Zoom, I have to enable attendees can chat with who they can chat with. It defaults to no one. It didn't used to do that. So I just realized that. So if you guys have a question, now's the time to type it in, because now you can. You couldn't before for some reason. I'm gonna have to ask Zoom why they did that. Okay, so here we go. A couple questions for you.
Okay.
What width do you like for your spread?
Typically, I use $10. You know, obviously there's a trade-off, but that's what I've always used. It gives you a little more room if you get in trouble in terms of you don't hit your maximum loss nearly as quickly, but on the other hand, you have more at risk as well. So I don't know, but I always use $10.
Okay, and then Bill says, please say again what the 200% rule is.
If you put on your credit spread, you could use this on any credit spread. But if you put on your credit spread, let's say we sell it for $1 credit, then day after day, as you bring up your account and look at that spread, just either click on something in your broker's site or whatever to estimate what you think the debit would be to close it. And when the debit to close that credit spread is double or 200% your original credit, then you've hit the rule and you close the spread.
Okay, let's see, a couple more questions here. What's your contract size and assets under management is Jay's question.
Oh, well, I don't, let's see, I manage my own money and one other friend. All of the flying with the Condor, it varies a lot in terms of those clients. I know some of them are trading 150, 200 contracts per month, and quite a few in that range. But I don't know what the total is. I don't ask them those questions. I only know how many they're trading when they volunteer it in conversations. But But I don't actually manage very much money other than my own and one friend that I have.
Okay, and then Rayner asks, were results based on Reg T or span margin?
No, this is regular margin, regular.
Reg T?
Yeah, I guess I was trying to think of Reg T. That isn't the day trading thing, is it?
No. Reg T is like cash margin essentially. It's not risk-based margin. It's like what your max risk is.
Yeah, that's what I base it on. I have portfolio margin, but I don't use that for, well, I mean, obviously use it. I take advantage of it, but I don't use that for the results.
Right. And then Rajesh asks, any changes you made in the trading following the 2020 results?
2020 was an interesting year. I botched up my condors, took losses that were a lot larger than I should have. For my trading group, it's interesting. We hit all of our stops for the trades we had out there in late February. And so we were totally in cash. And then I was following the Investors Business Daily follow-through methodology, some of you may be familiar with, and decided it was time to get back in about the second week in April. And consequently, we started trading then, and through the rest of the year, we ended up with 27% gain on the trading group trades, which is pretty impressive, I thought. And but I never could dig out of the hole. We had profits the rest of the year on the Condors, but we just took too many. We took 3 losses January, February, March, and couldn't survive that. So since then, 2020 for most of my trades, for example, in fact, I just misspoke. The conservative income, where we just sell calls and puts, which is our most conservative trade, it ended up at 27% for the year. And that was very unusual because that service normally is 12, 15%, something like that, 18 at most. And I forget what the trading group ended up at, but it was a banner year. It was 3 digits. I forget exactly what it was, but the only reason we did very well in both conservative income and the trading group is because we had stops that took us out in February. So we didn't take that full 35% hit in March. And with the Condors, unfortunately, I got hit 2 or 3 times there. So it was my worst performing in 2020. Otherwise, we did real well.
And Serge asked, he sees that you have automatic trading. What's the portfolio size for that?
Well, I recommend, if people are doing the Condor, I recommend that $50,000 account is probably the minimum that makes sense. And the reason I say that is 2 things. One are commissions, of course, because on the auto trading, I have a arrangement with a registered investment advisor and the brokerage that does his trading behind him in Chicago. But since you've got real people actually having to get my email, structure the block trade for all of my clients and put that through and so forth, they charge, I think it's about $1 a contract. So it's higher than what you normally are paying. And so I always tell people, just because of the commissions, and also when we put on a hedge, if we're putting on one of those put hedges, you need to have some extra capital. And so I usually recommend 50,000 for the minimum on the Condors. For the trading group, we have about 5 trades on per month on average. And I would say, if you have a $10,000 account, you probably can put all 5 on and not have any problem. And of course, some people are trading much larger than that, but those are the typical. And on the conservative income, I recommend people have a $100,000 account for that, because the nature of the beast there, when you're selling puts and covered calls conservatively, you're not making large amounts of money. You need the capital. And so when you're having several of these positions, I actually, that particular service, each one of my services mirrors one of my accounts. And conservative income, I have an account that's about $150,000 and it has portfolio margin. So I can trade a lot of large positions, even though they're just covered calls or cash secured puts. But I recommend that people have at least 100,000 to follow that service. Although I know a lot of them that do follow it don't have that, but they just take the first 2 or 3 trades and live with that. But those are the kinds of recommendations I make when somebody inquires. And the auto trading is very good. I've been working with those people since 2011, and I have audited it several times, and they on average meet my fills, and sometimes they're worse, sometimes they're better, but they're always close. They do very, very well.
Okay, and then see the question that I don't know if I read this. Read your books. Are you still applying calendarization?
Playing calendars is the question.
Calendarizing.
Oh, yeah, I still use calendars. I use them primarily in the trading group in advance of earnings announcements. In other words, I'll put on my calendar with a long call or put beyond the announcement and the short call before, and I'll do that, 2-3 weeks ahead of the announcement. And typically what you're doing there is you're benefiting from the increased volatility for that long option, and you're selling these short options as you get closer and reduce your cost basis. And then I close everything out before the announcement. So that's primarily what I use calendars for. They certainly, the only other place I've used them, but I don't do that right now, but it's a good way to boost your time decay, is with your condors. Just put an at-the-money calendar in the middle of the condor, and it just boosts the time decay returns.
Another question, when you got hit with your Iron Condors, did you follow your rules or did you deviate?
I'd have to go back and tear off the scabs and look at that closely. But as I recall, at least one of those, I was suffering from the hope syndrome. I was thinking that no, it's gonna bounce and so forth. And so at least on one of those, I took it entirely too far before I acted. And like anything in this business, that is the kiss of death. You can't delay. It's just like one of my condors right now is the April one. And when the market was heading up here maybe a week ago and it looked like it wasn't going to stop, I was looking at that on a Friday and I couldn't figure out, should I close those call spreads and roll them up or not? And the delta on the shorts was, I think, at about 25. And so I was starting to think maybe I should get out of Dodge. And then I finally decided, well, I had reasons for both cases. And so I closed half of the calls and rolled them up and left the others. And so that's worked out pretty well. So, sometimes I act wisely. Sometimes I revert, but
You're human, right?
yeah.
Last question I see is, have you tried Iron Condors in shorter time frames, like 0 DTE, for instance?
No, I haven't. The closest I've come to that, I've used Iron Condors with my trading group on the Fed announcements. I'll buy or I'll sell the Condor on the SPX the morning of the announcement, and those have actually worked out well. But I'm pretty conservative with them. I'm only making maybe 18%, something like that. So I'm pretty far out of the money, and so far at least I'm doing very well with that. Every time they have a Fed announcement, but it's interesting to watch. I always bring up an SPX 1-minute chart and watch it as we get to the announcement and then the press conference, and it's amazing how much it jumps around.
There's some fireworks, aren't there?
Yes, there are. It's amazing. I was just about ready to throw in the towel on my call spreads in this last one, and then it pulled back and everything was good. But then I felt lucky that my options expired that evening, because the next morning I took off to the moon. So, it's dangerous stuff. But that's the closest I've gotten to that.
Well, and I put in the chat your website, just if people don't have it. Plus, it's on the screen, but I don't see any more questions. So, Kerry, really appreciate you coming and answering questions about your Iron Condors. They look very interesting. So, congratulations on sticking with it. I remember there was a quote. Was it Bruce Lee? I think it said, he doesn't fear the man who's practiced 10,000 kicks. He fears the man who's practiced one kick 10,000 times. So you've been doing Iron Condor for a long time, and the success rate shows that. So congratulations and thanks again for coming.
Thank you. It's my pleasure, Tom. It's nice to catch up with you.
Yeah, likewise. So maybe do it again sometime in the future.
Yeah, I'd like that.
All right. Well, thanks everyone. We'll see you next time. And thanks again, Kerry.
You're welcome.